Manuel Aalbers, you are a professor at the Catholic University of Leuven. You are a geographer and you're leading a research group on the intersection of real estate finance and states. And there is one topic you are especially working on, and this is the financialization of housing. Can you give us, for the beginning, a little definition? What does this mean, financialization?
Yeah, financialization is a very general process that we find not only in housing, but in all kinds of different markets. It basically means that things become treated as if they're something financial. So you can think of housing, that is a place to live, but people also treat it as an investment. So that is in a very basic form what financialization of housing is.
Okay, and how as a geographer did you find this topic? What really interests you in it?
Yeah, so I've always been interested in housing. So ever since I was an undergraduate student, I've been interested in housing issues. And I was more interested in issues of inequality, poverty, and how they are related to housing. But then I realized to understand those things well, I didn't need to understand only welfare policies and housing policies, but also financial policies. So I started to look much more into those. And I realized that the people who are looking into them, typically economists, are not really interested in the same kind of questions that I am. Actually making this connection between the housing market and inequality, how that's shaped also in part through finance. So this is in a way how I got interested, and then at some point the financial crisis broke out, 2007, 2008. And just around that time I started to read about financialization. And you can imagine that timing of starting to read about financialization through other people's work, often not related to housing, and then the crisis breaking at that moment, I sort of had to bring them together.
Okay, maybe we can go now a little bit more into detail. What exactly are the factors of financialization? How is it driving the house prices higher, the rent? I think that we all can witness the last decades that there was a huge inflation. And how exactly is financialization driving this process?
Yeah, so this sounds like a relatively basic question, and maybe it should be the basis, but it's going to be a complicated and possibly long answer. So one element that is central to financialization is that it becomes easier to make money or with real estate rather than with producing something. And if I say easier to make money also through real estate, I'm not talking about the production of real estate, so not the construction of houses or offices, but I'm thinking of owning buildings. If you own a building, in a way, you don't produce anything. You may buy an existing building and you don't add to the production of the economy. And what we've seen in the last few decades, this is not something that started in the last 10 years, but a movement that started in the 1970s, is that it basically becomes easier to make money or with real estate than it is to produce something. And we see that very clearly in many Western countries, but increasingly also in other parts of the world, where we also see that manufacturing doesn't pay off anymore. Why would you produce something if you have a return of investment of maybe 3 or 4%, whereas you put your money in real estate, and even if you do it very conservatively, you make 5 or 6%. In a way, then it becomes a no-brainer. You put your money in finance and real estate, you don't need to do much for it, so there's less risk involved as well. You don't need to deal with labor unions if you just own a building, and you don't have a whole staff producing it. The production side is another thing. So in a way it becomes not only more profitable, it becomes easier to make money or with real estate. So this is one important driver that's driving the financialization of housing. Another one is at the household level, that for people who might not be the super rich people. We often talk about very rich people, but a lot of it is well-off middle-class people who have some extra money. And more people these days don't necessarily have a state pension fund, but they might be self-employed, they might be entrepreneurs. They want to save for their pension. And what do? They buy some extra properties. Why do they do that? Property is something they typically understand. They already own their own house in many cases. And what they feel is, if I put my money in another house, I can rent it out, I can make money that way. I understand that better than the stock market. Stock market, you can make much more money, but you can also lose more money. Over the long term, actually the profit rates in the stock market tends to be much higher than in real estate overall. But yeah, for people who don't want to take that risk and who don't really understand stocks, real estate is a much more interesting investment. So this is another reason that's underlying this. But then if we come to the financial institutions themselves, this is also important. So what financial institutions have started to do, especially banks, but it depends a bit on the country, because there's other institutions as well. If we look at the mortgage market, a lot of those institutions, of course, give mortgage loans to people so they can buy a house. This seems like a very basic need, and you say like, well, that should be a basic function of banks. What we often don't realize is that for many banks, mortgages is the largest thing they do. It's more important than all the other forms sometimes combined. So the mortgage market as a share of the total financial market has increased massively over the 20th century, and especially since the 1980s. It's not the same in each country when this exactly happens and to what extent, but it happened in almost every country. And after Europe and North America, it's now also happening in Latin America, in East Asia, in the Middle East. So it's a trend that's becoming more and more global. And as I said, this seems like a good thing. People can afford a house if they get a mortgage. But what happens if people get out a mortgage, then often they will try to maximize the kind of house they can get. In many housing markets, housing has been expensive for a relatively long period of time. It's more expensive now than in the past. So people always try to maximize what they can get with their mortgage loan. So what does it mean then if you can get a bigger mortgage? You think you can get a bigger house, right? Bigger mortgage, bigger house. But if everyone gets a bigger mortgage, it basically means that all these people together are bidding up the housing prices. So the housing prices go up. And then people say, I need a bigger mortgage to pay the houses because they're so expensive. So for a while this goes on, the mortgages get bigger, the housing prices go up, the mortgages get bigger, the housing prices go up. But what is important here is that the driver are the mortgages. The mortgages make it possible for the housing prices to go up so much. And often this is misunderstood what the direction of causation is. People often think the mortgages need to be bigger because the houses are so expensive. But the mortgages are really one of the main drivers of why this is happening.
Okay, but there's also another phenomenon here. Banks are creating financial products out of those mortgages. I think this process is called securitization. Maybe you can go now a little bit into it and explain us what this is.
Yes. So one reason you could say why banks are able to do this is because they can resell mortgages to other investors. So this is the process called securitization. What it basically means is that in the past, if a bank would give out a mortgage, let's say 250,000 euros, those 250,000 euros as a loan would be on the balance of the bank. And each month, typically, people pay a bit of the mortgage, pay interest, so they make a little bit of profit, and the loan little by little goes down, and it slowly disappears from the balance of the bank. Now, what happens in the case of securitization? The bank waits until they've sold thousands of mortgages, but for a big bank that can be a month, thousands of mortgages. For a smaller bank that might be half a year. Then what they do is they sell those mortgages typically to an investment bank. So an investment bank that's not a bank that gives mortgages to people, they basically deal with big companies, financial investors, and sometimes also governments. These investment banks buy all these mortgages. That means that all these mortgages are directly off the books of the banks. Why is this good for the banks? Because that means they clean up their balance sheets and they can start all over again. So whereas in the past it might take 20 or 30 years for a loan to be paid off completely, now for many banks that happens almost instantly, within a few months. So that frees up a lot of capital. Banks can give more mortgages, they can do other things. Now what happens when those mortgages are being bought by these investment bankers? These investment bankers don't want to keep the mortgages. They do a process which is called securitization, where they combine all these mortgages together and then they resell them again to investors. But they don't sell, say, my mortgage to one investor and yours to another one. What they do is they sell the rights to all these mortgages, so the right each month to get a little bit of a payback plus the interest rate. They sell it to many different investors. So let's say there's 100 mortgages and 100 investors. Rather than one investor buying my mortgage, each of these 100 investors all buy 1% of my mortgage, they all buy 1% of your mortgage, and so on and so on. Why is this attractive to investors? Because they completely spread the risk. Right? You know, if there's 100 people, a few of them are not going to be able to pay off their mortgage loan. Typically, it's not their fault. Many times it happens because people lose their job, divorces are very important, but the problem is you don't know if that's going to be me or you or someone else. So it's much more attractive for these lenders to own a wide set of mortgages and own just a little piece of them. Then if something goes wrong, this is completely calculated into the system. And then the risk level, theoretically, for them should be very low. So I say theoretically because, as many people may know, and some people may not know, one of the roots of the financial crisis in 2007, 2008 was that the securitization process was going wrong. Why did it go wrong? Because in places like the US, but to some extent also Ireland, Spain, a few other countries, some of those mortgages were given to people either who shouldn't have gotten mortgages in the first place, because based on their income, and especially the stability of the income, not even the height of the income, but the stability of it, it would have been very difficult for them to pay off the mortgages. Plus, a lot of mortgages had been sold with very high interest rates to people who actually would have been able to pay off the mortgage if it would have had a low interest rate.
Do you think that there's the risk that this could happen again?
This could happen again, but I don't think it would happen in exactly the same way. I mean, history repeats itself, but it never repeats itself in the same way, right? So, yes, something will go out of hand because there's a lot of finance coming into the mortgage market, into the housing market more generally. But securitization, especially in the US, is a bit more limited now than it used to be. Not as much as some of the people from the Democratic Party wanted, because there was a very strong lobby from the financial sector. But now it is less likely that this will completely go wrong. But the other thing is securitization is more widespread now. It's a little less common in the US, in the UK, and a few other countries where it was massively used before 2007. But it's now becoming more and more common in countries that didn't use it before.
How's the situation in Europe? Is this a widespread thing in Europe?
Yeah, so in Europe, before 2007, this was very common in the UK, the Netherlands, few of the Scandinavian countries. It was becoming more common also in Spain. Spain has one of the rapid rise in this. France was doing a little bit of it. And what we see after the financial crisis is that in some of these countries that did a lot of it, it's now a little bit less. But in a lot of countries that did very little of it, or did none of it, it's now becoming slowly more common. It's not a massive growth in most countries. In France, it has been a bit more of a rapid growth and then it's slowed down again. But what is interesting here is the role of the European Union. The European Union is actively rolling out the mechanism of securitization from countries that already did it, mostly Western European, to countries in the EU that didn't do it yet, which are many of the East European countries, but also a few West European countries who didn't do securitization yet. So the European Union is promoting this as a technique to also free up money, as was the original reason for doing it in the US. So yeah, there's now actually countries that in 2007 didn't have much of a crisis because they didn't do this, who are now also doing this. And the European Union has developed a framework which they call safe and transparent. But in effect, what is safe and transparent about it is what the banks have to do themselves. So there's very little monitoring of this process. So the monitoring is mostly happening by the financial sector itself. Of course, investors are now warned a bit more that this can go wrong, so they might be a little bit more careful than they were before 2007. But it is a fact that it's now more common in countries that didn't have it before because of the push of the European Union.
Okay. Let's speak maybe a little bit about the other big development in the concerning financialization. You mentioned that people realized that they can make a lot of money out of it in this sector. And I think this was driving the development of very big real estate firms.
Yes.
Maybe you can explain us a little bit about this.
Yeah, so the real estate firms, and there's a whole range of them, I will get into them in a minute, they are very important also for driving financialization. So before we talked mostly about home ownership and mortgages, but these funds are buying up a lot of housing and they often buy up existing housing. Why is it important that they buy up existing housing? Because it means they drive up the rents. Just imagine if one investor is willing to pay more for a housing block than another investor, it means that this new investor sees more profit opportunities. How does it see more profit opportunities? Typically by raising the rent. This may be different for new buildings they build. You know, there's no comparison for an existing landlord, but most of these funds primarily own existing housing units. This is beginning to change a little bit. Some of these funds become more interested in actually developing housing, primarily is my gut feeling because it's becoming harder and harder to buy up large portfolios because there's so much competition. So some of them, to make sure they keep growing, start constructing new housing, but typically they buy up existing housing. And why do they do this? Again, because real estate gives you a return of investment. Many of those funds is 5 or 6%, 7 maybe. Some of the more risk-seeking funds might get a little bit higher, up to 10%, but it's not the massive profits that you see in some other sectors of the economy. They're good profits, but it's not something extremely excessive, what they would call double-digit figures in financial markets, so anything above 10. Typically, they're under that amount. And how do they do this? Where does all this money come from, right? This is the other part of the question. A lot of these funds primarily use money from pension funds. Why do they use money from pension funds? Well, because the pension funds are very interested in investing in products that are relatively low risk, but have a good return on investment. So just like households compare stocks and say, this is too risky for me, and they say savings, nice, but I don't get a return on investment, pension funds do the same.
Okay. You mentioned that those real estate firms, they are buying up houses and then they raise the rents to be more profitable, etc. But you also said that now, because there's maybe too much competition, they're also building more and more. Couldn't you say this is a quite good thing?
Yeah, so some of them are starting to build more new housing, and this in itself could be a good thing. In many places there is a shortage of housing, but the problem is most of them build with an investor in mind. They build with an end investor, sometimes it's the investor themselves. A lot of these funds build and then also sell part of it to another investor, again to spread risk, but they typically build for the top of the market. And then many economists would say, well, if you build for the top of the market, higher income people move in and they sell their houses or rent out their own units and it goes to other people in society. The problem is there's very little evidence for this. A lot of housing being added to the top of the market doesn't bring the prices down in the middle or in the bottom of the market. And why is this the case? It's partly because there's often a little bit more being built, but not enough actually to fulfill the actual needs of society. So it means that there's still a shortage of housing, and as long as there's a shortage of housing, especially a shortage of affordable housing, that means you can always ask more in a way than would be the sensible price from the perspective of the tenant. So yes, it helps that they build a lot, or that some of them build a lot, but it doesn't help enough because they don't necessarily build for where the biggest demand is, which is for affordable housing. So that is a bit of a problem, and it would be possible to regulate them and to ask them to say, okay, if you build new housing here, according to the planning regulations, you would need to build, say, 40% affordable rental housing, you do 30% middle income housing, and 30% you can do whatever you want. That is a regulation that you can put on them and ask them to do this. And they will say like, no, we can't make a profit anymore. But in the end, places that have these regulations in place actually still have new construction going on.
I think in Munich they did implement something like that, right?
Yeah, in Munich is one of the places. Vienna has some of this. A lot of Dutch cities do have these regulations. And none of those places are perfect, right? Munich is very expensive. Many Dutch cities are expensive. Vienna is becoming increasingly expensive. But you would have to think what would happen to those places if there weren't that investment. These are all also cities that economically do quite well, are also very popular places to live. So possibly without these kind of regulations, the prices would be even higher. People often compare to places where there's no regulation. Often economists like to do this. They say like, this city has a lot of regulation and the prices are high. This other city has very little regulation and the prices are not as high. But very often then they compare two places where one, a lot of people want to live, and the other one, a lot of people don't want to live because it's a less attractive city. So yeah, we can disagree or agree or disagree about how nice some places are to live. But yeah, we know that some of these cities are very attractive places to live. So in a way, they need the regulation to make it possible for some of the population at least to have somewhat lower rents.
Okay, here in Luxembourg, for sure that we have a huge financial sector, and what we are speaking about, it's developed on a global scale. I think it's quite everywhere can witness those inflation and prices. And which role plays Luxembourg into this?
Yeah, so Luxembourg within the bigger global or European constellation plays different roles, but the most important role is perhaps that it's a sort of tax haven. So many companies register in Luxembourg because taxes are lower. And this is also the case for real estate funds. So there's a lot of real estate funds that register in Luxembourg, and most of them are not active in Luxembourg. Most of those funds don't own housing. Most of them own offices, some of them own shopping malls, some of them own storage units, but also that's part of real estate. And of course, where there's an office building, it also means there can't be a house. So in a way, of course, these markets are also related. So a lot of those funds are registered here, own real estate abroad. Some of them, around 10% of them, also own housing, also again abroad. And what it basically does is that Luxembourg as a state, as a financial center, is facilitating the extraction of rents from tenants in other countries. So you could say Luxembourg is part of the problem in this case, of these funds coming in, buying up housing and raising the rents. So in Germany, these funds are massive. In absolute terms, Germany is the second largest market for residential real estate funds in the world after the US. In relative terms, so the percentage of housing these funds own compared to the total stock of housing, it is by far the largest market in the world. Some of these funds may also be registered in Luxembourg. Some of them are also registered in Germany itself or somewhere else. But it means that, yeah, the raising of the rents in Germany is partly facilitated by the fiscal system of the state of Luxembourg.
Okay. The last months there was quite change in the European Union, not only European Union, also in the US and in Great Britain and many other countries. We are witnessing rising interest rates. Mm-hmm. Is this, in your opinion, slowing this process?
Yeah, this is a good question, and it may be too early to give a definitive answer, but I think we can see a few trends that are interesting here. On the one hand, it becomes more difficult for these funds to borrow money, because what I didn't mention yet, a lot of these funds don't just get money from the pension funds and from other investors, they also borrow money to buy housing. Why do they do this? If they can borrow money for 1% and they can make a profit of 5 or 6%, that basically means that they made a lot of extra profit just by borrowing money. And that's with money that they don't need to pay back to their investors. So in a way, they can use that within the process, or they can pay it back to their investors in even higher profits. So this becomes a little bit more difficult for them. But of course, if their interest rate goes up from 1 to 3%, that looks massive, 3 times as high. But 3% is still lower than 5 or 6. So they might have to take a little bit more risk in this case. But if they're secure, they can make this 5 or 6% return on investment on the houses they own. A slightly higher interest rate might not be a massive problem for them. They may lose a little bit of profit, but not so much that borrowing is out of the question for them. The other part that's important of the raising interest rates and where it has a more direct impact is on households. Because people often think when you get a mortgage, what you pay per month is mostly paying off the mortgage, right? Paying off the principal of the loan. But for most people, a large part of what they pay each month is actually the interest rate. So if the interest rate goes up quite a bit for households, this means that their monthly payments go up a lot. So it often also means that they are either less willing to take out a massive mortgage loan because their payments become too high, or banks lower how much they will lend out because they say, because of the higher interest rates, I have to give you a little bit less money, otherwise, based on your income, the monthly payments will become too much. So that means that if the mortgages become a little bit smaller overall, that of course for each of the households, that means they can pay a little bit less for the houses, and that means that the housing prices may go down a little bit. And we already see that happening in several cities and several countries across the world where this is happening, but not everywhere. But what we see in those countries, of course, is because the prices drop, for who is this interesting? Is this interesting for, let's say, young people wanted to buy a house? No, because they need a mortgage. It is interesting for those investors who don't need to borrow money. So if we go back to those earlier upper middle class households with some extra spare money, they often don't borrow the money to buy a second house. So now the prices might drop a little bit and they might be able to pay off those houses. So it might not necessarily benefit the big funds, although that is a bit of a question mark, but it may benefit smaller investors who invest with their own money. So that might not necessarily be financialization, but it would still have the effect that more houses go to landlords and go away from the owner-occupied market and to people who basically make a living on renting out the houses.
I want to come back to what you said before about the pension funds investing heavily in those big real estate firms. What is the relationship between state-run entities like those pension funds or the state itself and the financialization we can witness and those real estate firms?
Yeah, so there's many relations. Of course, a lot of pension funds are either state sanctioned or some of them are actually public pension funds. So then in a way, it is an arm of the state that is investing in the housing, sometimes of its own people, but often these pension funds invest in real estate funds all over the world. So it may be the case that one fund from one country owns the housing of the worker who pays into that same pension fund. This is in theory possible. And in Germany, since these funds own so much of the housing, there's probably thousands of cases like that, where someone pays rent to a pension fund that pays their own pension. So then it's good that the pension has a good return on investment, but at the same time, it's driving up the prices. So yeah, it's not necessarily that useful if it results in a higher rent. One other thing that is important here, that some of these real estate funds, and internationally they're known as real estate investment trusts, but in different countries they may have different names, is in a way a mechanism is built into these funds that they pay lower tax. So I was mentioning Luxembourg, a lot of funds register here because of lower taxes. You could say this is something that Luxembourg overall offers as an advantage, lower taxes. But these real estate investment trusts are also registered in countries that may have relatively high tax rates, but the government says for these funds we make an exception.
Why is the government or those countries doing this?
That's a very good question. I mean, one reason would be the lobby from real estate companies in the financial sector. That is, in a way, you could say the operational answer. This is how it may be happening. But then, of course, they need to have arguments that persuade the government. And one of them is very often that they say, we invest in housing, you need more housing investment, so if you give us good conditions, then we can do this. Besides, we work with a lot of pension fund money, so it's also great for the pension funds that we do this. So they use these kind of arguments. And governments often think like, yes, we need more housing investments. We have very high housing prices, we have a shortage of housing, so this is great. But again, most of these funds would be buying up existing housing. In Germany, where I said these funds are very big, by far most of their investment is in existing housing. So they're not adding that much housing to the housing stock, which means again that they drive up the prices. But the argument that often convinces governments is more investment in housing is by definition better. And I think this is one thing, if we can change one thing with this interview, is that people stop thinking that investment in housing is by definition a good thing. If people think, what does investment in housing mean? Does it mean investment in existing housing and one person or one fund willing to pay more than the previous owner? Then it's just driving up prices. And I think if we can break that link between investment being good for the housing market and actually questioning if that's the case, I think we would have been winning a lot by informing people about this.
And I think isn't there also some sort of financial dependence on those real estate trusts, because you said that when those pension funds investing in those funds, the state has a quite interest that he gets a nice return on investment, right?
Yeah. So in some cases, as I said, pension funds may be putting their money in it, so that's directly related to the state. In other cases, of course, even if they pay a lower tax, they still pay some tax. Also, some of that money goes back. It's also, a lot of it goes to the financial sector. So the government may also think this may be creating some jobs there. So there's all of these kind of related arguments. But then on top of this, what we also see in some countries is that they invest heavily in housing that is in some way subsidized by the state. So one of the things that in some markets where they're not very big is becoming their growth market is elderly housing and student housing. Student housing is often made possible with student loans to the students, sometimes not even loans, but direct government benefits to students. So the government benefits or the government loans would pay the students who are then able to pay the rent for the housing unit owned by a big fund. Likewise, elderly housing, of course, older people, they will often have pensions. On top of that, a lot of money goes into their healthcare facilities. So a lot of that is also government money, which then goes to these people who then pay the rent to these funds. So we see that a lot of these funds become interested in where the state in a way guarantees that the income is going to be paid. What we see in Germany specifically is that some of them invest a lot in affordable housing, and you might think like, wow, affordable housing, that's great that they invest in it, but again, they buy up existing affordable housing, so it often becomes more expensive. But why do they do this? You'd think low-income people might be a bit more riskier. In Germany, if people are on welfare benefits, the rent doesn't go to the tenant and then to the landlord. The rent can go directly to the landlord. So for a landlord, that's great. First of all, you don't need to send the bill to 1,000 individual tenants. You can just send the bill to the welfare office of a particular municipality. And also it means that the particular municipality will typically pay in time. For your administration, it means one payment only. And of course it means that you don't need to deal with late payments. If you have 1,000 tenants, there's always going to be a few that are late. And many of them are just a few days late, but you need to send them a reminder, which does a lot of work. And then a smaller percentage of them over time won't be able to afford their rent. There's not going to be a problem if the state pays directly. So in a way, here the state is taking away a massive risk away from these investors and moving it to the state itself. But then, yeah, the state is able to do this with tax money. So you could say the taxpayer money meant for welfare is indirectly benefiting also, of course, these people. I'm not saying this is no longer the case, but it's also quite directly benefiting these funds.
By the way, those places are quite often overpriced. They're paying quite high rents for those places we're living in. And probably it's also because people are not directly complaining if it's directly coming from
someone else pays.
State.
So
it's just going this way, and they can.
And of course they maximize it.
Yeah.
So these governments, the government might set a limit and say we will subsidize up to this amount. So let's say if the government says we subsidize up to 600 and the flat used to be for rent for 500, well, you can easily raise it a little bit because you will know exactly how much the government is willing to pay. Which again is taking away the risk, because in the market, if you raise the rents too much, at some point people won't be able to afford it anymore. So then you might have an empty unit. But here, you don't need to worry about it.
Okay, maybe you can, now that we spoke about all those points, what can we do about this? On the local level and on the state level, maybe you have some ideas.
Yeah, so one thing I've already mentioned is actually using planning regulations. To make sure that you demand that for new construction, some of it is affordable housing. And of course, you can discuss a long time what affordable means, if that needs to be rental housing, if it needs to be social housing, what kind of things. There's all kinds of specific conditions that you need to agree on within the government. And in a way, the exact boundaries are political. But the fact of doing this would already help a lot. And as I said before, developers and investors will complain, but in the end, they will often comply. One indirect advantage of doing this is that you will actually drop the land prices, because land prices don't have some natural value. They are basically based on how much money you can make by building up the land. So if the developer can build fewer luxury units on the same land, they can make a lower profit. But the profit doesn't disappear. In the end, the land price will go down a little bit, because if the profit becomes too low, they will not do it. So then the land price in the long term, this may take a few years, will also drop. Why is this an advantage? Because it also means that the government can be buying up land itself. Then with that land, it can use to either develop the houses themselves, or they can give the money to a non-profit organization to do it, or they give it to a group of residents, grassroots organizations. In Belgium, where I live, community land trusts have now become quite popular, which is a model where the ownership of the houses is split from the ownership of the land. And the ownership of the land is basically communal. But that means that someone still needs to pay for the land. So if the price is lower for that, that also helps. So with planning regulation, you can do a lot. Another form of regulation that's important is regulation of the private rental sector. And that is for me always a no-brainer. Why is it a no-brainer? Because it doesn't cost any money. Because it's just a regulation, you don't need to put any tax money in it. So if the government decides today or tomorrow that rents on private rental housing cannot go up by more than, say, inflation or by, say, income levels. We used to always say inflation in housing studies, but now inflation was very high last year. So inflation can be a bit risky. You could also say we do half of the rise of inflation plus half of the rise of average income. Then you compensate also that some landlords might have higher prices, but you also take into account that incomes don't always follow entirely inflation. So that could be a good solution.
Are there good examples of countries that implemented this?
Well, Germany has been doing this for a long time. It's doing it less well now than it used to. But Germany has quite some rules about this. Unfortunately, it changed the system in a way that is less good than before. But still, I would say the German system is better than what a lot of other countries have. The Netherlands does a lot of this as well. And France also does a lot of this as well. So speaking from Luxembourg, 3 of your 4 neighboring countries do this to some extent. So it would be interesting to compare those systems. I think especially in the Netherlands and Germany, they changed it for the worst. But as I said, still better than not having any regulation. Of course, also protecting tenants if they don't pay the rents, that you cannot directly evict them. That would also help. There needs to be good reasons to evict them. Of course, if people are unwilling to pay or are just being difficult, those people do exist. There should be reasons in the end after some months to evict them. But there's also people who lose their income, who have high health bills. They should get a break in a way and not be evicted because something happened outside their fault. So this is another thing the government could do. And of course, investors again wouldn't like it, but it wouldn't hurt their profits so much. Because these are just a few cases where this would be the case. And if we look at the raising of the rent, you would say like, well, if they can make money now by renting out the unit, if you can do the same next year, plus half of inflation, plus half of income rise, then you still be able to make money, right? Then there should be no reason why you can't make money. Of course, they can make more money if they can raise the rent with whatever they want. So this to me is something that you should do any government as soon as possible. I tell that everywhere where I'm asked in a specific country what to do, I say regulate as well. In the Netherlands where they do it, I say regulate it better than you now do. But if there's not much regulation, this is where you need to start. Then, of course, you also need to regulate financial streams. This is a bit more complicated material to explain sort of in layman's terms, but a lot of the money glowing around between investment funds, private equity funds, pension funds, is regulated to a certain degree, but it's not so much regulated where the money goes into. So you could also have some regulation for that. Then, of course, you could take away the tax advantages of certain funds. And for me, this is not about saying we shouldn't have these funds, but it's about saying we want a level playing field. Why should the butcher store at the corner here pay more tax if he wants to buy a house than a big fund? Maybe the butcher really needs the extra house he rents out because that's his pension fund. Then why does he need to pay more taxes on it than a fund? There's no reason to give one actor an advantage over another one. So I will take those advantages away from these funds. In Luxembourg, the very specific element of lowering your income tax if you invested in real estate is quite absurd to me. You should take that away because, again, a lot of that investment doesn't go into new construction, which maybe the government hoped for. A lot of it goes in housing that's either already existing or that was already being planned anyway, but otherwise might have been sold to other people. So all those tax advantages you need to cut. And then people say like, but then we take away all these money streams from people. Well, the great thing is if you take these tax advantages away, that means a little bit more tax comes into the government. You can actually use this money to then contribute to a more affordable housing solution, which would be building social housing. The land I mentioned before to use that, you can build the social housing on it. You can stimulate all these grassroots initiatives. So this actually means that you don't necessarily need to tax people more. You can just reroute the taxes. You take away some tax advantages for some actors that now, for no particular reason, well, maybe there is a particular reason, but they would say we have an unfair advantage. You take the unfair advantage away, and with that tax, you make sure that you build affordable housing.
Here in Luxembourg, we are discussing a lot about now implementing a tax on land, but at the moment it's basically not existent. Do you think it's a way to mobilize those lands that will be constructed, maybe more buildings be constructed on it?
I think it could help, but of course it depends how much you tax it. I understand now that the land prices in Luxembourg go up every year, and in a way it's a good investment not even to build on it, because you can just hold the land and the land will become worth more. So if you just raise the taxes a little bit, that might be too small of an incentive to do something about it. So you would really have to raise it significantly. And you can have a condition also tied to this. If the land doesn't become built, if it has a designation to be built, you could say you get a number of years to build on it. If you still haven't been built on it, we'll expropriate the land and we pay to you the price that the land unbuilt has. So if it's been used for cows to graze, we pay you for whatever that's worth. And then we develop the housing on it as the state, or we ask someone to do it on our behalf. And then of course it becomes much less attractive to hold the land, because you lose the risk, you run the risk of losing the land and to get a much lower price for it. So then what you need to do is also put in place these planning regulations I mentioned before, where you actually demand that a significant part, say 40% of the housing being built, is affordable to regular people. So this is very important. Otherwise, you might get more new construction in Luxembourg, but you will get a lot more new construction again at the top of the market, and not all of that is going to trickle down to lower income people. So I would say get that regulation for planning in place first, and then make sure that people get taxed more. And then, yeah, hopefully some of that will become built. If it doesn't, you need to raise the taxes even more. And the expropriation could be something that you have sort of as a last solution to go to. But the goal shouldn't be necessarily to expropriate the land. The goal should be almost like a stick. We have to stick here. We don't want to use it, but if you don't develop, we have to stick here. And then, yeah, either they will sell the land to someone who will develop, or they might be developing themselves.
Okay. Thank you very much, Manuel.
You're welcome.